Okay, we need to talk about a hidden force in the crypto markets. Seriously, it's the secret reason behind some of the most confusing, most frustrating price action you'll ever see. And today, we are pulling back the curtain on it. It's called gamma exposure. You know this feeling, right? You're staring at the charts, watching Bitcoin just sit there. It's like it's stuck in mud at one price level, absolutely refusing to move. And then, out of nowhere, some other coin just launches into orbit. It's maddening. And the answer probably isn't on the indicators you're used to looking at.
Well, the answer lies in this thing called gamma exposure, or GEX for short. And I want you to start thinking of it like an invisible force field that surrounds the price, either pulling it in or pushing it away with incredible strength.
So what is it really? Simply put, GEX measures the pressure on options market makers, the big firms that are on the other side of all those options trades. To protect themselves, they have to constantly buy and sell crypto, and all that activity creates this force field that can either pin the price down or send it flying.
And here is the absolute key to understanding all of this. When you buy or sell an option, a market maker is on the other side of that bet. But here's the thing, they are not in the business of gambling. They want to stay neutral, no matter what happens. So to do that, they are forced to buy or sell the actual crypto to hedge their position. And that constant hedging, that's the engine that drives the whole GSEX effect. Now, this hedging activity creates two completely different market environments. On one hand, you have positive GEX. This acts like a powerful magnet, pulling the price back towards a certain level. It creates stability. And on the other hand, you have negative GEX. This is the exact opposite. It's like a snowball rolling downhill, getting bigger and faster. It creates instability and massive explosive moves.
All right, let's really dig into the mechanics here. Understanding how these two faces of GEX work is like seeing the secret playbook for the market. It shows you exactly how the big players can either calm the waters or pour gasoline on the fire.
Okay, so let's start with the good guy, the stabilizing force. In a positive GX world, there are a ton of call options out there. This puts market makers in a position called long gamma. And this forces them to do what every trader wishes they could do perfectly. They sell into strength and they buy into weakness. So as the price goes up, they sell. As it goes down, they buy. This constant counterpressure creates those sticky zones where price just can't seem to break away.
Now, let's flip that completely on its head. Welcome to the negative GX scenario. Here, put options are in control and market makers find themselves short gamma. Their hedging behavior does a complete 180. Now, they are forced to buy as prices rise, and even worse, they are forced to sell as prices fall. You can see how this becomes a feedback loop, right? Their own hedging amplifies every single move. This is why trends can get so incredibly violent and explosive.
Okay, so the theory is cool, but how do we actually read this stuff? How do we use it to our advantage? Well, it all comes down to three key metrics that, when you put them together, give you a practical map of these hidden forces. First up, net GEX. Think of this as the weather forecast for the market. If it's positive, you can expect calm, stable, low volatility conditions. If it's negative, you better buckle up because high volatility is on the menu. And if it's hovering near zero, that's the gamma flip zone. That's a danger zone where the market can switch from stable to chaotic in a heartbeat.
Next, we get more specific with call and put GEX. These actually point out the key levels on the chart. A huge amount of call GEX creates what we call a call wall, a massive resistance level. And a huge amount of put GEX creates a put wall, a powerful support level. The important thing to remember is these are not just lines drawn on a chart. These are levels being actively defended by billions of dollars in dealer hedging.
And finally, our third metric is absolute GEX. This one is super important. While net GEX tells you the direction of the force, is it stabilizing or destabilizing, absolute GEX tells you its strength. Think of it this way. Net GEX tells you if the wind is at your back or in your face. Absolute GEX tells you if it's a gentle breeze or a hurricane.
And understanding this difference is absolutely crucial. Just look at this table. In both scenarios, A and B, the net GEX is the exact same, negative 150 million. So both are signaling a high volatility environment. But look at the absolute GEX. In scenario A, it's a massive 500 million. That means any little price move is going to trigger a tidal wave of forced hedging. In scenario B, it's only 100 million. The market is still unstable, but there's just not as much fuel in the tank, so moves might be weaker. See the difference?
All right, let's put this all together. Enough theory, let's walk through a real-world scenario and see how you can use this information to trade smarter. We're going to look at the anatomy of a potential flash crash.
So here's the setup. Bitcoin is trading at $58,000. We look at our GEX map and we see that net GEX is negative. Red flag number 1. The market is primed for volatility. We also see a giant call wall up at 62K, which is like a concrete ceiling on the price. And, this is the scary part, just below us there's what's called a gamma cliff, a spot where if the price falls, a cascade of forced selling will kick in.
So, what's the play here? How do you trade this? Well, the GEX map gives us a very clear strategy. First, because net GEX is negative, you immediately reduce your leverage. This is not the time to be a hero. Second, you set tight stop losses just below that 58K support level. You have to be ready for an explosive, fast move if that level breaks. And finally, you don't try to catch a falling knife. You wait. You wait for the price to fall into a zone of high positive GEX, where those stabilizing forces can kick back in, before you even think about looking for a reversal.
This is the real power of using GEX. It gives you at least 3 huge advantages. You can predict the type of market you're in, quiet or chaotic. You can identify the key support and resistance levels that actually matter because they're being defended by dealers. And you can time your trades so much better, entering with lower risk and knowing exactly where those GEX-defined profit targets might be.
Look, at the end of the day, this isn't some magic crystal ball that predicts the future. What it is, though, is a brand new lens. It's a way to see the market differently, to see the invisible forces that are pushing and pulling on the price every single second.
So let's just hammer home the key takeaways one more time. GEX is just market maker hedging pressure. Super simple. Positive GEX means stability, negative GEX means volatility. Those put and call walls you see, they are your most important support and resistance levels. And finally, net GEX is your simple guide for when to press the gas and when to hit the brakes on risk.
And this quote just says it all perfectly. There is a world of difference between knowing that Bitcoin is at 60K and understanding that it's sitting on $150 million of negative gamma, just waiting to explode. That understanding is your edge.
So I'll just leave you with this one question. Now that you know this hidden force exists, now that you know how to spot it, what are you going to see on the charts tomorrow that you didn't see today?